In this video, we are going to talk about how to find better ways of trading a famous chart pattern called head and shoulders. The head and shoulders pattern, just like any other pattern, is very easy to spot in any price chart. However, this ease comes with a high cost for the trader, which is that such pattern is not a precise way of trading. That's a big problem because the less precise a trader gets, the more risk he has to take. If you trade far from the reversal points of the market, you will have to use much larger stop loss orders. And to compensate for the large stops, you will need to use much greater target orders because you need to maintain risk-reward ratios within a certain range. The level of precision of a trader is directly associated with his capacity to survive in a market in the long term, because precision is what allows the trader to catch trade opportunities that have a small and logical stop loss order with a great potential for targets. That's an absolute necessity if you want to survive in the market in the long term, which you should since nobody wants to make money only in the short term. In this video, I intend to show you a much better way of seeing the market without the common chart patterns. For a head and shoulders pattern to emerge, we need 3 highs and 2 lows in between these highs. The high in the middle must be the highest one forming the head part of the pattern, and the first and third highs form the shoulders. The lows in between these 3 highs serve as axes to draw what's called the neckline, which is the line that allows traders to trade this pattern. If we connect the 2 lows of the pattern, we'll see how the neckline extends into the future. There are mainly 2 ways in which chart patterns are traded. You can wait for the breakout of the neckline in this case, or you can wait for a small retracement after the breakout. Either way is a bad idea because most of the times, the place in the chart where these breakouts occur are usually far away from any significant reversal point of the market. We can clearly see that here by looking at the place where the price broke the neckline of the head and shoulders pattern. Notice how it's far away from the reversal points we can see in the chart. Even though we can see that the head and shoulders pattern breakout would yield a profitable trade in this situation, we have to pay attention to a less obvious detail about this trade, which is the risk-reward ratio. Since the breakout of the neckline will point to an entry far away from the logical stop-loss placement, you will need a large price movement in order to maintain a certain level of risk-reward ratio. The recommended risk-reward ratio is between 1 to 3 and 1 to 4. In this case, even if you were able to spot the very end of the downward movement, you would get something like 1 to 2 risk-reward ratio. You might think that this is not so bad, but remember that in a real situation, you would get much less than that since it's difficult to predict the end of every movement. That's if you used the smaller stop available. If you use the other more conservative stops in the chart, the risk-reward ratio would be even worse than that. The bottom line here is that we can get closer to the reversal points of the market by paying attention to what buyers and sellers are really doing instead of memorizing the name of a chart pattern and blindly trading with it for the sake of simplicity. What we want to realize here is that buyers and sellers have been contracting their volatility, creating lower highs and higher lows. Just like we connected the lows of the neckline of the head and shoulders pattern, we can connect the highs as well. Once we draw such line, there are a few things that become clear. The first is that the head and shoulders pattern confuses itself with the triangle pattern. However, even if we consider this as a triangle from the beginning, the textbook way of trading it would be at the breakout of the lower line, so the trade would be exactly the same as in the head and shoulders pattern. The better and much more precise way of trading this market to the downside is by using fractal bars, frequency lines, and simple trend lines. Observe that by connecting the 2 highs forming a downward trend line, price ends up hitting the line a 3rd time, and this is where a few other elements also correlated. At this price level, we can draw what's called a horizontal frequency line, which is a more precise form of support and resistance. Notice how this line catches the alternating motion of upper and lower tails, and then it ends up intersecting almost exactly with the point where the price touches the trend line the 3rd time. At that point, we also have the powerful fractal bar formation, which would be a 3rd technique happening in the same exact point in price. A trader that was able to watch this unfold in real time could enter the market right after the fractal bar with a stop above the high of the fractal bar for a very aggressive entry, or with a stop above the last high for a more conservative approach. Observe that if you were only looking for chart patterns, you would completely miss all of this information, and while the real trade was happening, you would be still waiting for the breakout of the neckline. Just so you understand how that's critical, let's compare the risk-reward ratios between the Head and Shoulders trade and the trade using frequency lines and the fractal bar. Let's assume that both trades have the same stop and the same target for simplicity's sake. The Head and Shoulders trade will yield around 1:2 risk-reward ratio with the entry right after the price broke the neckline. The fractal bar trade, however, would use something around 1:5 risk-reward ratio. That's a 150% increase in the risk-reward ratio just by tuning the entry. A larger risk-reward ratio means that you can have more peace of mind in future trades because you can be wrong more often and still make money consistently. That's the true importance of the risk-reward ratio psychologically speaking. If you want to learn more about trading with the fractal bar and frequency lines, check out my Fractal Flow Strategy video course and my Price Action Trading Volume 1 video course for a wide array of precise techniques and a logical way of interpreting the markets. I hope you learned something useful with this video. If you wish to support the channel, please click the like button, subscribe to the channel, activate the notifications, and leave your feedback below in the comment section. Thank you for watching, and I hope to see you in the next videos. Take care.